Everyone wants their money to be working for them and to be a multi-millionaire by the time they retire. Investing in stocks makes it incredibly easy for you to put away $100, $500, $1,000 a month so that when you retire in 40 years or less or more, you'll be worth many millions of dollars. $1,000 a month over 40 years at an 8% return would give you a $3.3 million portfolio. Welcome back to the channel. I'm Jacob Fisher, and today we're talking about the investing basics. Things like what broker, what companies do I invest in, how much should I invest per month. There are 10 main topics that are all listed in the description with timestamps below. Each topic will then have a future or potentially one video already made on it with more in-depth and more detail about that specific topic. With that said, let's get into it and tap the like button. One of the first things you need to decide is which broker you want to keep your investments in. There are a ton of brokers out there like E-Trade, TD Ameritrade, Robinhood, TradeStation, Interactive Brokers, and the list just goes on and on. Just about all of them offer commission-free trades, and you can thank Robinhood for that because they kind of pioneered that commission-free trading style. Robinhood is one of the only ones that offers fractional shares, as does M1 Finance, and actually Charles Schwab has stock slices, I believe is what they called. Any one of those names would be good to choose for your first broker, because if you're investing at $5, $20 a week, then you can buy shares of Amazon without actually having to shell out thousands of dollars, because Amazon is so high in price right now, and it's hard for an average investor to get in there without the use of fractional shares or other types of things like a loan from someone or an inheritance, obviously. I think if you're investing smaller amounts, maybe up to $1,000 a month, you should choose a broker that allows you to get fractional shares from every company that you purchase, because that just makes your life so much easier, and you can have auto reinvesting in things like DRIP going in, which most of the brokers do have DRIP, but not all of them have the fractional shares. E-Trade doesn't have fractional shares, but they have DRIP. DRIP is dividend reinvestment program, which just allows you to reinvest the dividends that a company gives you back into the stock. So it'll buy partial shares, and every company does this now. But again, on Robinhood or M1 Finance or any fractional share, you'll actually get a fraction of the dividends that come out that also get reinvested, just because you have more fractional shares. So if you wanted a totally hands-off approach, then you can consider things like core portfolios from E-Trade or Stash or Acorns, which all invest for you with, again, fractional shares, but generally they're in mutual funds or ETFs or another way of doing it. All of them are pretty good. You choose your investment style, whether you want it safe, conservative, or super aggressive, or just in the middle, and then you invest maybe $100 a week or $150 a week, whatever you want to do, and then they'll manage the portfolio for you for a small fee. What kind of account is that second question? Also sort of part of the first, I guess, depending, how you look at it. Anyways, an IRA or just a normal brokerage account, those are the options you have, and then I guess 401k, but let's keep it simple. IRA, normal brokerage, but the IRA can be broken down into both a traditional and a Roth IRA. Traditional means you get a tax break now, and a Roth IRA means you get a tax break when you take your money out because you already paid taxes on the money you put into it. I am a big proponent of first building up a normal brokerage account, not an IRA, so you can focus on building maybe investments for a house or just some other things that you can take that money out and use it right away. Once you've done that, though, then you can focus on building up that IRA and contributing to an account that is tax-free for retirement. But I am first focusing on saving money from without penalty until I buy a home, and then start up an IRA and all that stuff. Keep in mind there are also income limits on IRAs. For a Roth IRA, specifically, not a traditional, you need your gross income to be under $137,000 to be able to contribute to it. These next ones kind of fall into the same category again. You should not try and time the market, but rather buy consistently over time. So don't time the market and buy consistently over time. That means no matter what the market is doing, you should be purchasing shares in whatever you want to invest in every month, whether it be ETFs, mutual funds, stocks, or bonds, whatever it is, every month or week, you should be investing. Buying constantly and consistently over time has shown to beat timing the market again and again. If you tried to time the market and bought every single dip, you still would have less money at the end of 60 years compared to someone who just bought consistently every month. This is known as dollar cost averaging. And if you look at the image on the screen, you can see how the study done by people at Yale, so you know it's pretty trustworthy if they're at Yale, to prove how much more your account value can grow with dollar cost averaging compared to buying every single dip. This is also investing $100 every month. So if the market is up, down, in the middle, then you just keep on buying and waiting until you need the money, or with whatever you want to do. Moving on, we should be choosing companies you believe in and not companies that are just up on hype. A great example for me is Nikola. I don't believe in them as a company right now, so I am not investing in them. They had a large spike a few weeks ago, so many people got in because they saw they were up, 40% or something, a big number. But then news came out that the CEO left and there were scams and a bunch of other stuff happened. Had you chose to invest in it because you saw they were up a ton, you would have lost money. But had you chosen to invest in a company you believe in, or just not invest at all, then you wouldn't have lost money on them. Or maybe you were someone who believed in them before, saw they were up big, and then sold because you didn't think they could be sustainable at that price. I know that sounds obvious, but try not to invest in companies you don't believe in or wouldn't purchase a product of theirs. This helped me not only choose good names for my portfolio, but to look out for names that could potentially be scams. I'm not saying Nikola is a scam, but it's in this example it spiked and then went down a bunch. Or Workhorse used to be a penny stock. I know people did a video on that a while ago, but I do know that it used to be a penny stock, so I don't want to invest in them because they were full of pump and dumps. Identify the type of portfolio you want. This one can be determined by just a few questions, but let's keep it simple with growth and dividend portfolios. Would you rather have a portfolio that grows 10 to 20% per year and pays you 1 to 3% in dividends, which is what a lot of stocks give you? Or would you rather have a portfolio that pays you 3 to 6% and grows 8 to 12% a year? The larger growing one is, you guessed it, a growth portfolio where you don't care necessarily about the dividend a company provides you. All you want for your portfolio is for it to keep growing year over year at a fast rate so that when you retire at 65, you have more money. Option 2 is a dividend portfolio that you choose to invest in because you want your dividends to pay for things that you might want right now, or you just want more dividends. If you have $2 million portfolio, a 6% dividend yield, which is high, would give you about $120,000 a year just in dividends by you doing pretty much nothing. You could live off the dividends if you really wanted to, which is what some people choose to do with a dividend portfolio. For ease of access, you can just invest in ETFs, so you don't need to go out there and find companies to invest in. There are plenty of videos of mine on growth and dividend ETFs to make your life a bit easier. Look for stocks that are down but are solid companies. And without getting too technical into this on how to find them, which will be another video, you can look for solid investments that might be down 10 to 20% because they had a bad quarter or a bad month, or just some news came about them that wasn't good, but they're still a functional company. I did this with Pinterest because it had a bad month, but is now up around 60% for me as my best performing stock, all because I decided to buy it because it was down, and that's not a bad place to get in when stocks are low. Now I know I said don't try and time the market, but I don't think this counts because I will continue buying Pinterest because I still think it's a solid company. I'll keep adding to my position, which increases my dollar cost average, but I don't really mind at all because I see it going up in the future. You can do this with other names, like if Tesla had a bad quarter, but you believe in them, then you might as well invest $50 or something a month just so you can dollar cost average to whatever they're doing, and eventually they'll grow up higher. If you buy during months of a downtrend, then when it comes back, your position will grow that much larger. So this kind of ties into with consistent investments over time, along with buying stocks that you believe in. Lastly, we have invest as much as you can early on. I think this is critical because the more you invest now, the more you have later on. If you can live a little frugally, invest an extra $100 a month, that would turn into anywhere from $60,000 to $260,000 in 20 years at an 8% to a 20% interest rate. Just saving that $100 every month for 20 years would only be $24,000 in your portfolio in cash. That sounds like a good idea in my book to potentially have, well, double, quadruple, 10 times the amount that just cash would give you. Maybe try out other income ideas in, a separate video of mine, or just try and spend a little bit less. Plenty of options out there to save some money. Let me know down in the comments what you think of these ideas, and if you are an experienced or new investor, I just want to know. I upload videos on Monday, Wednesday, and Friday on travel and finance, so if that sounds like something interesting to you, make sure you hit that little subscribe button down there. Thank you so much for watching, and until next time.